Right now, silver lease rates just flipped positive for the first time in 14 months. That one number, a number most retail investors have never heard of, is telling you something that the spot price absolutely is not. The spot price says silver is calm. The lease rate says someone, somewhere, is desperate to borrow physical metal, and they are willing to pay a premium to get it. Those two things cannot both be true at the same time. And yet here we are. You are watching this because the mainstream financial media will not explain what a positive lease rate actually means for your stack, your savings, or the 4,000 tons of silver that COMEX is supposedly holding right now. They won't touch it. So let's go through it together, number by number, data point by data point, and by the time we are done, you are going to understand exactly why this moment matters. Let's start with what the vaults are actually showing. As of the most recent COMEX inventory report, registered silver, that is the metal officially available for delivery against futures contracts, sits at approximately 135 million ounces. That sounds like a lot. It is not. Not when you understand that open interest on silver futures contracts currently represents claims on over 48 billion ounces of paper silver. Paper says there are 356 paper claims for every single registered ounce sitting in those vaults. That number doesn't exist in a fair market. A ratio like that isn't a market inefficiency. It is a structural fiction, and it has been running for years. But something just changed. And that change is the lease rate. Silver lease rates turned positive. Right now they are sitting at approximately +0. 35% annualized on 1-month contracts. That might sound trivial. It is not trivial at all. For most of the last 3 years, silver lease rates were negative or near zero, meaning institutions could borrow physical silver for free, or nearly free, suppress the price by flooding the paper market with borrowed metal, return it later, and pocket the spread. The system was built to keep silver down. Negative lease rates were the fuel. And now that fuel has flipped. When lease rates go positive, it means the pool of available physical silver to borrow is shrinking. It means someone needs real metal and cannot find enough of it at any price they were previously willing to pay. The paper market is still showing you one number. The lease rate is showing you something different entirely. But that's not the part that should concern you most. Let's talk about what COMEX actually is, because most people watching this are operating with an incomplete picture. COMEX, the commodity exchange, is the primary futures market for silver and gold in the United States. It is owned by the CME Group, which is based in Chicago. Every day, thousands of contracts trade on COMEX, representing 5,000 ounces of silver each. The vast majority of these contracts are never intended to result in actual delivery of physical metal. They are settled in cash. They are used for hedging, speculation, and, critics argue, price management. The critical distinction is between registered inventory and eligible inventory. Registered silver is deliverable. Eligible silver is stored in COMEX vaults, but not available for delivery unless the owner reclassifies it. Right now, eligible silver is sitting at roughly 880 million ounces. Registered is 135 million. Those two numbers are not the same thing, and the gap between them has been quietly widening for 18 months. Here is what that means in practice. If a buyer on COMEX decides to stand for delivery, meaning they want their actual silver, not a cash settlement, they can only draw from that 135 million ounce registered pile. And against 356 paper claims per ounce, even a modest delivery demand creates a stress fracture in the system. We are not talking about a theoretical stress fracture. We are talking about something that is already showing up in the data right now. If you are getting value from this breakdown, now is the time to subscribe and hit the notification bell. The kind of data we are walking through today, lease rates, registered inventory shifts, CME margin mechanics, this is what gets buried under headline noise. This channel exists to dig it out. Subscribe now so you don't miss what's coming next. Let's keep going, because the lease rate flip did not happen in isolation. It happened inside a pattern that goes back further than most people realize, and it connects institutions that have left fingerprints on this market before. In November 2023, JPMorgan reclassified approximately 13 million ounces of silver from eligible to registered status in a single reporting cycle. Overnight. No announcement, no press release, just a quiet reclassification in the COMEX Vault report that most people scrolled past without reading. Why would one of the largest banks on earth quietly move 13 million ounces of silver into deliverable status? There are two possible answers. Either they were positioning to deliver against contracts they knew were coming, meaning they had advance intelligence of demand. Or they were shoring up registered inventory to prevent a visible collapse in that number at a moment when scrutiny was rising. Neither answer is reassuring. Wall Street is not confused. They know exactly what this means. Now let's layer in the Shanghai premium, because this is where the East versus West divide becomes undeniable. The Shanghai Gold Exchange, the SGE, has been trading silver at a premium to the London spot price that has ranged between $1.20 and $2.40 per ounce for the better part of 14 months. The premium held through the entire dump in February. It held through the March consolidation. It is not closed. A persistent geographic premium of that size is not a trading inefficiency. It is a signal of structural physical demand that the paper market in London and New York is not reflecting. China is not importing paper silver contracts. China is importing physical metal, moving it east, and paying above spot to get it. Every ounce that moves east is an ounce that is no longer available to backstop the 356-to-1 paper stack in New York. And then something strange happened to the vault numbers. Between January and March of this year, registered COMEX silver inventory declined by approximately 38 million ounces, a 22% reduction in deliverable stock in roughly 60 days. That kind of drawdown at that speed has happened exactly 3 times in the last 12 years. The first time was in early 2011, right before silver ran to $49.51. The second time was in January 2021, during the retail-driven squeeze attempt. The third time is right now. Once is accident, twice is coincidence. 3 times is policy, or in this case, 3 times is a physical market screaming that supply is genuinely tightening, while the paper price refuses to reflect it. But here is what should really disturb you about the 2021 comparison. In February 2021, as the silver squeeze attempt gathered momentum and registered inventory began dropping, the CME Group, the owner of COMEX, raised margin requirements for silver futures by 18% in a single weekend move. 18%. Overnight. That margin hike immediately forced leveraged longs to liquidate positions, crushed the paper price, and stopped the squeeze dead. The physical demand was real. The delivery demands were real, but the rules of the game changed at exactly the moment the system was being stress tested. The premium held through the entire dump. Physical premiums over spot reached $8 to $10 per ounce at retail. Paper said silver was worth $24. Your local coin dealer said $32. That gap is the truth. Paper says one thing, the vault says something different. Now consider what that 2021 intervention tells us about the current setup. Lease rates in 2021 never went positive before the squeeze attempt was crushed. The institutions had enough borrowed metal to keep the paper lid on. Right now, lease rates have already flipped. The borrowing pool is already constrained. The inventory drawdown is already in progress. The Shanghai premium is already persistent. All of these signals are arriving simultaneously and ahead of any visible retail surge in demand. This is not 2021 with a delayed fuse. This is structurally different. And that difference matters enormously for what happens next. Let's talk about the mechanism that most people miss when they look at COMEX stress. Open interest, the total number of outstanding futures contracts, is currently sitting near its 5-year average despite the inventory drawdown. Normally when registered inventory drops sharply, open interest should compress as traders recognize reduced deliverability. It is not compressing. Open interest is holding. That means the paper promises are staying on the books, while the physical backing for those promises is walking out the door in the form of deliveries to Shanghai and Zurich. This is the impossibility at the center of this system. Mathematically, 135 million ounces cannot be the legitimate backing for claims representing tens of billions of ounces of exposure. That equation has only one resolution, and it is not gradual. It is not orderly. It is a repricing event. Once you understand the ratio, the price action makes sense, not as a fair reflection of supply and demand, but as a managed fiction maintained just long enough for the right parties to get positioned on the other side. And before we go deeper, share this video right now with one person in your life who owns silver and doesn't understand why their stack isn't moving the way the fundamentals should dictate. The information we are breaking down here is scattered across CME Vault reports, SGE premium data, and lease rate feeds that nobody is aggregating in plain language. This is the aggregation. Send it to someone who needs it. Let's go back further, because the pattern we are looking at did not begin in 2021 or even 2008. It began in its modern institutional form in 1980. In January 1980, silver reached $49.45 per ounce, driven by the Hunt brothers accumulating physical metal and attempting to corner the market. What happened next is one of the most important case studies in commodity market history. The exchanges changed the rules. COMEX and the CBOT implemented Silver Rule 7, a position limit that prevented new long positions while existing shorts could roll freely. The price collapsed from $49 to $11 in a matter of weeks. The Hunt brothers were destroyed, the shorts survived, and what you need to understand about 1980 is not that the squeeze failed. It is that the infrastructure for preventing a squeeze, margin changes, position limits, the ability to alter the rules mid-game, was formalized and institutionalized in the aftermath. The playbook that was used against the Hunt brothers is the same playbook that was used in February 2021. Same mechanics, different decade. Now here's the 2011 comparison, because 2011 is actually more instructive for our current setup than 1980. In April 2011, silver ran from $18 to $49 in roughly 8 months. It was not driven by a single actor or a coordinated retail effort. It was driven by a combination of dollar weakness, physical demand out of Asia, and a growing understanding that paper silver was multiply claimed. Sound familiar? In the 5 trading sessions between April 28th and May 5th, 2011, the CME raised margin requirements for silver futures 5 times. 5 times in 5 days, silver dropped 30% in that same window. Physical premiums held. Mint sales stayed elevated, but the paper price was broken. And after the dust settled, silver spent the next 4 years grinding lower as institutional shorts rebuilt their positions and physical inventory was quietly restocked. The West is still pricing this like 2019. The East has been pricing this like 2024 and beyond for over a year. Now let's come back to the present and the three things happening simultaneously that make this moment different from both 1980 and 2011. First, lease rates have flipped positive before the squeeze, not during it. In 2011, lease rates stayed negative or near zero throughout the run-up. The market was not signaling physical scarcity until after the price had already moved substantially. Right now, the lease rate signal is arriving early. That early arrival suggests the scarcity is structural, baked into the physical supply chain, rather than speculative or demand-driven alone. Second, the BRICS nations, specifically China, India, and Russia, have been systematically reducing their dollar reserve holdings and increasing commodity holdings, including precious metals, at a pace that has no historical precedent in the post-Bretton Woods era. The IMF's COFA data shows central bank gold purchases at record levels for 3 consecutive years. Silver does not appear in central bank reserve data because it is not classified as a monetary reserve asset. But the SGE premium tells you exactly where physical silver is going. It is going east, and it is not coming back. Third, the mining supply picture has quietly deteriorated. Global primary silver mine production peaked in 2016 at approximately 900 million ounces annually. It has not recovered to that level since. Meanwhile, industrial demand, driven by photovoltaic solar panel manufacturing, EV battery components, and 5G infrastructure, has grown by approximately 27% over the same period. The Silver Institute's data for 2024 shows a physical market deficit of over 215 million ounces, the 4th consecutive annual deficit. The paper market is pricing silver as though supply and demand are balanced. The physical market is running a 215 million ounce annual hole. This number doesn't exist in a fair market. And then something strange happened to the most recent CFTC Commitment of Traders report. The commercial net short position in silver, that is, the total short bets held by the banks and dealers who trade on behalf of institutions, actually increased in the most recent reporting period by approximately 4,200 contracts, representing 21 million additional ounces of paper, silver, sold short, during a week when registered inventory was declining and lease rates were moving positive. Those two things are moving in opposite directions. The physical signal says scarcity. The paper position says the shorts are doubling down. This is either the most confident trade in the history of the silver market, or it is a last-ditch defense of a price level that is becoming harder and harder to maintain. Wall Street is not confused. They know exactly what this means. The question is whether they have the physical inventory to back the bet, and the vault numbers say they do not. Right now, there are 3 types of people watching this breakdown. The first type is watching their silver position, checking the spot price every hour, feeling frustrated that the fundamentals aren't showing up in the price yet, and starting to doubt their thesis. The second type is newer to this market, has heard about silver manipulation before, but isn't sure whether this moment is different or whether it's just another cycle of noise. The third type understands what a lease rate inversion means, understands the registered to open interest ratio, has been accumulating physical metal on every dip, and is using this breakdown to confirm what the data has been telling them for months. If you are the third type, or if you want to become the third type, this is the moment where the preparation you have already done starts to matter. Let's talk about what actually happens when a COMEX stress event reaches a breaking point, because this is where most analysis stops and ours does not. There are 3 possible resolutions to the current setup. The first resolution is a forced cash settlement. If delivery demands exceed registered inventory, COMEX has the contractual right to settle remaining delivery claims in cash at the prevailing spot price. This has happened before in smaller commodity contracts. It would mean that holders of COMEX futures contracts who expected physical delivery would receive cash instead, at a price that does not reflect the physical premium in the real market. You would be made whole on paper. You would not receive your metal. The second resolution is an emergency rule change, the 2011 playbook, the 1980 playbook. Margin requirements spike overnight. Position limits are imposed on longs but not shorts. Open interest is force reduced. The paper price drops. The physical premium widens. The 2 markets diverge visibly and dramatically. Anyone holding paper silver gets hurt. Anyone holding physical silver watches their stack hold value against the paper chaos. This is not speculation. This is documented history, repeated. The third resolution, and this is the one that institutions are quietly preparing for and that nobody in mainstream finance will discuss, is a managed repricing. In this scenario, COMEX registered inventory is allowed to decline to a level that forces a renegotiation of the paper to physical ratio. Open interest is gradually reduced through non-renewal, and silver is repriced substantially higher over a compressed time frame to attract new physical supply into the registered category. This is what a genuine silver squeeze looks like when it goes all the way. Not a spike and reversal. A repricing of the fundamental relationship between paper claims and real metal. The premium held through the entire dump in 2021 because the physical market already knew something the paper price refused to admit. If the third resolution is where we are headed, the 2021 premium was the preview. Before the final piece of this analysis, and this is important, if you are not subscribed to this channel yet, fix that right now. Because the next video in this series is going to cover something that none of the major financial channels will touch. The specific COMEX rule amendments that were quietly filed in the last 90 days that give the exchange significantly expanded authority over delivery settlement in the event of an inventory shortfall. The filing exists. It is public. Nobody's talking about it. Subscribe so you are there when we break it down. Now let's talk about what this means for you specifically. This is not financial advice. Your money, your decisions. But here is what the data is telling us. If you are holding physical silver, coins, bars, allocated storage, you are holding the asset that the lease rate signal, the Shanghai premium, the registered inventory drawdown, and the 4 consecutive years of physical market deficits are all pointing toward. You are early. Being early in a repricing event is uncomfortable. It is also how wealth is transferred from the impatient to the patient. Do not let the paper price, which is a managed fiction built on 356 claims per ounce, tell you that your physical stack is wrong. The vault says something different than the paper price, and the vault is getting harder to ignore. If you are holding silver through an ETF, particularly SLV, you need to understand what you actually own. SLV is backed by metal held at HSBC in London. The fund's prospectus explicitly allows for the use of sub-custodians and does not guarantee that all metal has been independently audited to your satisfaction. If lease rates are rising because physical metal is scarce, the metal that backs your ETF is the same metal that is being competed for by COMEX delivery demands, SGE purchases, and industrial users running supply deficits. You are in line. Physical holders are not in line. They already have their metal. If you are a leverage trader using COMEX futures, the 2011 and 2021 case studies should be tattooed on the inside of your eyelids. Margin hikes happen without warning. They happen precisely when the momentum is in your favor. The house changes the rules at the worst possible moment for your position. If you are right about the direction but wrong about the timing, a margin hike wipes you out before the move completes. The asymmetry is not in your favor on a leveraged long. If you are sitting on the sidelines waiting for the spot price to confirm what the physical market is already telling you, understand that the confirmation will be the last signal you receive. By the time the paper price catches up to the lease rate, the Shanghai premium, and the inventory drawdown, the entry point you are waiting for will no longer exist. The setup does not announce itself with a headline. It announces itself with a filing at 3 a.m. and a vault number that doesn't add up. Here's what we know. Silver lease rates have flipped positive. Registered COMEX inventory has fallen 22% in 60 days. The Shanghai premium has held above $1, 20 per ounce for 14 consecutive months. The physical market has run a deficit of over 215 million ounces for the 4th straight year. The commercial short position increased during a week of physical scarcity. And a COMEX rule amendment was quietly filed that gives the exchange expanded authority over delivery settlement. Every single one of these data points is public. Every single one of them is being ignored by the mainstream financial press. They are not separate stories. They are the same story, told in 5 different languages, all arriving at the same conclusion. The conclusion is this: the paper silver market and the physical silver market are drifting apart. They have been drifting for years. But the lease rate flip is the moment where the drift becomes measurable in a way that even the most skeptical observer cannot dismiss. When you have to pay to borrow something that was free to borrow for 3 years, it means the something is becoming genuinely scarce. The price of silver does not yet reflect that scarcity. That gap between what the paper market says and what the physical market is doing is the trade. Once you understand the ratio, the price action makes sense. Not as organic price discovery, not as a function of supply and demand finding equilibrium, but as a managed surface over a pressure that has been building for 4 years and that now, for the first time in this cycle, has a visible crack in it. The lease rate is the crack. The inventory drawdown is the crack. The Shanghai premium is the crack. The same cracks appeared in March 2011, 6 weeks before silver ran from $34 to $49. 6 weeks. The script is not new. The playbook is not new. Same playbook, different decade. The difference is that in 2011, you did not have China systematically pulling physical metal east at SGE premiums, while BRICS nations accumulated commodity reserves as a strategic dollar alternative. The pressure underneath this market is structurally larger than 2011. The paper lid is the same size it has always been. The question is not whether it holds. The question is when it doesn't. Tell me in the comments, do you hold physical or paper silver? And do you think the lease rate flip is the signal, or are you waiting for something else? I read every comment, and I want to know where you are in this analysis. Hit the like button. This kind of breakdown takes hours to assemble from public data, and it helps the channel reach more people who need to see it before the next move happens, not after. Share this video with one person who stacks silver and doesn't understand why their stack feels wrong right now when the fundamentals are this clear. Most people will never see this data assembled in one place. You saw it. Help someone else see it. And subscribe to this channel right now, because the next video, dropping before the May 14th CME delivery window closes, is going to show you exactly what that quiet COMEX rule amendment filed at 3 a.m. actually authorizes, who benefits from it, and what historical precedent says happens to the silver price in the 30 days that follow a rule change like this one.